The 6 patterns that cost retirees $6,000 they never see coming. Robert spent 34 years as a postal worker in Central Florida. He was not wealthy, but he was careful. He maxed out his contributions every year, kept a healthy savings account for emergencies, and retired at 68 with a small pension, a traditional IRA, and Social Security coming in every month. His accountant ran the numbers and told him he should clear about $4,400 a month after taxes. Robert felt like he had finally made it. 14 months into retirement, he opened his first tax return as a fully retired person. The bill from the IRS was nearly $6,000 more than his accountant had projected. His Social Security was being taxed. His Medicare premium had jumped compared to what his coworker paid, even though they had similar incomes. And his IRA withdrawals had quietly pushed him into a higher tax bracket than he had ever been in while he was still working full-time.
Robert called his accountant frustrated. His accountant could not fully explain it, not because the accountant was incompetent, but because 6 separate IRS rules had intersected at the same time in Robert's situation, and nobody had mapped out that collision in advance. Robert had not done anything wrong. He had not cheated. He had not made reckless decisions. He had simply not known about 6 specific patterns the IRS uses to collect more from retirees who never see it coming. Every single one of those 6 patterns applied to his situation. What you're about to read is going to walk through all 6 of them. Not in vague general terms, but in specific dollar-level detail so you can identify right now which ones apply to you and what you can do about each one. This information is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. Yes, Leonard. Pattern number 1. The savings account that makes your Social Security taxable. You have more than $25,000 in a savings account, a high-yield savings account, a money market account, or a certificate of deposit. And that account is generating interest income. Here is what most retirees do not understand. That interest income is not invisible to the IRS. It flows directly into what the IRS calls your provisional income. And provisional income is the number the IRS uses to decide how much of your Social Security benefit gets taxed. Let me explain exactly how this works because most people have never seen this explained clearly. The IRS calculates something called combined income, also referred to as provisional income. The formula is your adjusted gross income plus any tax-exempt interest you earned plus 50% of your annual Social Security benefits, your provisional income. That total determines whether your Social Security check gets taxed and by how much. Here are the exact thresholds verified directly against IRS Publication. 915. For single filers, if your provisional income is below $25,000, none of your Social Security benefit is taxable. 0. If your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefit can become taxable income. If your provisional income exceeds $34,000, up to 85% of your Social Security benefit can become taxable income. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. Now, here's where the savings account becomes the problem. Say you are a single retiree collecting $18,000 a year in Social Security. You have $100,000 sitting in a high-yield savings account earning 4.5%. That account generates $4,500 in interest income annually. Even if your only other income is a small pension of $12,000, let's do the math. Your adjusted gross income includes the pension income and the interest income. That is $60,500. Add 50% of your Social Security, which is $9,000. Your provisional income is $25,500. You just crossed the threshold. Up to 50% of your Social Security benefit is now taxable. On $18,000 of Social Security, that means up to $9,000 is added to your taxable income. And here's the part that stings. Those thresholds have not been adjusted for inflation since 1983 for the 50% tier and 1993 for the 85% tier. That means every year that passes, more and more retirees cross those lines without ever making a financial decision that should have moved them there. The fix. The fix is not to close your savings account. The fix is to understand what types of accounts generate income that counts toward provisional income and which types generate income that does not. Qualified withdrawals from a Roth IRA, for example, do not count toward provisional income at all. Understanding this distinction is worth real money every single year. Let me give you one more real number to anchor this. If you are a single retiree with $22,000 in annual Social Security benefits and your provisional income crosses the 85% threshold at $34,000, up to $1,700 of your Social Security benefit can become part of your taxable income. At even a modest effective tax rate of 15%, that is approximately $2,805 in annual taxes on income, you may have assumed was fully protected. Over a 20-year retirement without any change in your situation, that adds up to $56,100 paid to the IRS from your Social Security benefits. Not because of any rule change, not because you earned too much. Simply because the interest income from your savings account was never factored into your income picture. That is the quiet cost most retirees never calculate because nobody showed them the formula. Pattern number 2. The IRA withdrawal that taxes your Social Security twice. You take withdrawals from a traditional IRA or a traditional 401k in the same year you collect Social Security, and you have never calculated what each additional dollar of withdrawal actually costs you. This is one of the most expensive misunderstandings in retirement finance, and almost no one talks about it the way it needs to be explained. When you pull money from a traditional IRA, that withdrawal counts as ordinary income. It raises your adjusted gross income, which raises your provisional income, which can make more of your Social Security taxable. And then your taxable Social Security is also taxed as ordinary income. So you pay taxes on the withdrawal itself, and then that same withdrawal triggers taxation on a portion of your Social Security. You are paying twice on one decision. Tax researchers have a term for what happens in the income range between the Social Security thresholds. Inside that band, some retirees face an effective marginal tax rate that is significantly higher than their stated bracket because every additional dollar of income makes 85 cents of Social Security taxable. Research has shown that retirees in the 22% bracket can effectively pay a marginal rate approaching 40% on certain dollars of income because of the combined effect of direct taxation and the Social Security tax torpedo. The strategy. The strategy to mitigate this is about sequencing, not elimination. If you can draw from a Roth account in years when your Social Security is most vulnerable to becoming taxable and preserve traditional IRA withdrawals for years when your income is lower, you can reduce the total taxes paid over your retirement by a meaningful amount. Here is a concrete example. A single retiree with $20,000 in annual Social Security and an adjusted gross income of $28,000 before any IRA withdrawal sits comfortably in the middle of the 50% taxability band. If that retiree takes an additional $10,000 IRA withdrawal, that withdrawal does two things simultaneously. One, it adds $10,000 to their ordinary taxable income. Two, it pushes more of their Social Security into taxable territory at the same time because their provisional income rises. Depending on where exactly they sit within the threshold bands, each dollar of IRA withdrawal can trigger significantly more than $1 of total taxable income. This is why retirement income planning is not simply about how much money you have. It is about which account you pull from, in what sequence, in what year, and what each withdrawal triggers downstream. If you have never modeled this with your actual income numbers, that is a project worth doing before the end of the year. Super pattern number 3, the Medicare premium that jumped because of income from 2 years ago. Your income is somewhere near $106,000 as a single filer, or $212,000 as a married couple filing jointly, and you're enrolled in Medicare. If those numbers sound familiar, here's why they matter. $106,000 is the 2026 IRMA threshold for single Medicare beneficiaries. IRMA stands for Income-Related Monthly Adjustment Amount. It is a surcharge the federal government adds to your Medicare Part B and Part D premiums when your income exceeds certain thresholds. In 2026, the standard Medicare Part B premium is $185 per month. That is what most enrollees pay. But if your modified adjusted gross income from 2 years ago exceeded $106,000 as a single filer, you pay more. At the first IRMA A tier, your Part B premium rises to $259.90 per month. The surcharge at that tier is $74.90 per person per month. For a married couple where both spouses are on Medicare, that surcharge applies to each spouse separately, which means the couple pays an extra $1,797.60 per year just at the first tier. At the highest income tier, the monthly Part B premium reaches $628.90 per month, and that is before Part D surcharges. The 2-year look-back trap. Now, here's the piece that catches almost everyone off guard. IRMA uses a 2-year look-back. Your 2026 Medicare premium is based on your 2024 tax return. The income you had 2 years ago determines what you pay today, which means a financial decision you made in 2024, a large IRA withdrawal, a Roth conversion, a home sale, any of those could be affecting your Medicare bill right now, and you may not have connected the two events. Additionally, IRMA A operates as a cliff system. Crossing a threshold by even $1 triggers the full surcharge for that entire tier. For a married couple, $1 of additional income can cost nearly $1,800 in additional annual Medicare premiums. If your income is anywhere near these thresholds, and especially if you have variable income from IRA withdrawals, capital gains, or Roth conversions, understanding how those decisions affect your Medicare premiums 2 years downstream is essential planning. The surviving spouse problem. There's one additional situation that deserves special attention. When a spouse dies, the surviving spouse must file as a single filer starting the following tax year. This filing status change cuts the IRMA threshold in half, from $212,000 to $106,000. While the surviving spouse may still have the same income as before, a widow or widower who is comfortably below the joint threshold can suddenly find themselves above the single threshold with no change in income at all. Their Medicare premium can jump by nearly $1,800 a year or more for reasons entirely outside their control. If you are married and you are planning your retirement income picture, modeling what happens to your surviving spouse in this scenario is not morbid planning. It is responsible planning. The appeal option. The good news is that if your income has dropped significantly due to a qualifying life event such as retirement, the death of a spouse, or divorce, you can appeal your IRMA determination by filing Form SSA 44 with the Social Security Administration. That form allows SSA to use more recent income data rather than the 2-year-old return. Knowing that this form exists can be worth thousands of dollars to the families who need it. Pattern number 4. The required minimum distributions that grow every year. Your required minimum distributions are growing every year and you have no plan to reduce them. Required minimum distributions, or RMDs, are the minimum amounts the IRS requires you to withdraw annually from traditional IRAs, SEP IRAs, simple IRAs, and most employer retirement plans like 401ks and 403b accounts once you reach a certain age. Under current law, most retirees must begin RMDs at age 73. For those born in 1960 or later, the starting age increases to 75, though that change does not take full effect until 2033. If you miss an RMD or fail to take the full required amount, the IRS charges an excise tax. Under the Secure 2.0 Act, that penalty was reduced from 50% to 25% of the amount not withdrawn. If you correct the mistake within 2 years by taking the missed RMD and filing IRS Form 55329, the penalty may be further reduced to 10%. But the penalty is not the main issue. The main issue is what RMDs do to your entire tax picture over time. The compounding problem. Here is the compounding problem. Your RMD is calculated by dividing your prior year-end account balance by a life expectancy factor from IRS tables. At age 73, the Uniform Lifetime Table factor is 26.5. So if you have $500,000 in your traditional IRA at the end of the year before you turn 73, your first RMD is approximately 18,968. But as you age, the life expectancy factor decreases. At age 75, the factor is 24.6. At age 80, it drops to 20.2. If your account balance holds steady or grows, your annual RMD increases. That growing RMD adds to your ordinary income each year, which progressively pushes more of your Social Security into taxable territory and can bump you into a higher IRMA tier. The retirees most affected are those who spent their entire careers in traditional pre-tax accounts and never converted any portion to Roth. By the time RMDs begin, the mandatory distributions can be larger than their actual spending needs, creating income they must recognize and pay taxes on, even if they do not need or want the money that year. The first-year RMD trap. There's also a specific first-year RMD trap that catches many retirees completely off guard. When you first reach RMD age, the IRS allows you to delay your very first distribution until April 1st of the following year instead of taking it by December 31st. This sounds like a benefit, but here's the problem. If you delay your first RMD to April 1st, you still must take your second RMD by December 31st of that same calendar year. That means 2 full taxable distributions land in one single tax year. 2 distributions in 1 year can push your income into a higher bracket, make more of your Social Security taxable, and potentially trigger an IRMA surcharge that follows you for the next 2 years. Many retirees take the delay option without anyone explaining the downstream tax consequence of doubling up in year 2. Knowing about this before you turn 73 or before your first RMD deadline arrives is the kind of information that saves real money. Strategies to manage RMDs. Strategies to manage RMDs include using qualified charitable distributions. If you are 71, 2 or older, you can direct up to $108,000 annually from your IRA directly to a qualified charity and have that amount count toward your RMD without flowing through your taxable income. This is one of the most powerful and underused tools in retirement tax planning. Another approach is a measured Roth conversion strategy in the years before RMDs begin, reducing the balance subject to mandatory distributions and shifting future growth into an account with no lifetime RMD requirement. If your RMDs are currently growing and you have no strategy to manage them, the trajectory only goes in one direction. The earlier you begin addressing this, the more tools remain available to you. Pattern number 5. The tax withholding. No one set up. You have not updated how taxes are withheld from your retirement income, and you're heading toward an underpayment penalty. When you were working, your employer withheld income taxes automatically from every paycheck. In retirement, no one does that for you automatically unless you set it up. And most retirees do not realize that their withholding situation has fundamentally changed the moment they retire. Social Security withholding. Social Security does not withhold taxes by default. If you want taxes withheld from your Social Security check, you have to proactively file a voluntary withholding request, which is IRS Form W-4V. On that form, you choose a withholding rate of 7%, 10%, 12%, or 22% of your monthly benefit. If you do nothing, the IRS receives nothing from your Social Security payments throughout the year. Then in April, you owe the accumulated tax all at once. Pension withholding. The same issue applies to pension income. Your pension administrator will withhold taxes from your monthly check only if you have set up withholding correctly using Form W-4P. Many retirees default to the wrong withholding amount when they first retire and never revisit it. IRA withholding. For retirees who take regular IRA withdrawals, the IRS typically withholds a default 10% when a distribution is taken from a traditional IRA, but that default may be either too high or too low, depending on your total income picture for the year. And if your total tax liability is large enough, the IRS expects you to make quarterly estimated tax payments rather than settling everything in April. The estimated tax payment deadlines in 2026 are April 15th, June 16th, September 15th, and January 15th of 2027. If you underpay throughout the year, the IRS charges an underpayment penalty. The safe harbor rule means you generally avoid the penalty if you have paid in at least 90% of your current year tax liability or 100% of your prior year tax liability, whichever is smaller. If your adjusted gross income exceeded $150,000 in the prior year, that threshold rises to 110% of your prior year tax. What the first year looks like. Here is what the first year of retirement looks like for a typical retiree who has not set any of this up. January through June. No withholding from Social Security because they never filed Form W-4V. Pension check withheld at the wrong rate because they never updated Form W-4P. 2 IRA withdrawals taken for home repairs with 20% withheld from each. But those withdrawals also made more of their Social Security taxable, which the withholding did not account for. By December 31st, this retiree has an income picture that looks substantially different from what their withholding covered. April arrives and they face a tax bill they did not budget for, plus an underpayment penalty on top of it. This is not a rare scenario. It is the default outcome for most new retirees who do not proactively manage their withholding before their first retirement tax year begins. And unlike some of the other patterns in this article, this one is entirely fixable with a single afternoon of paperwork before the year ends. Pattern number 6. The gift that created a Medicaid problem. 5 years later, you gave money or assets to your children or grandchildren in the past few years without tracking the gift tax annual exclusion. Or you made a transfer without understanding how it affects your estate and your potential Medicaid eligibility. This pattern operates on 2 separate tracks, and both of them can cost your family significantly. Track 1. The Federal Gift Tax Annual Exclusion. In 2026, the IRS allows any individual to give up to $19,000 per recipient per year without filing a gift tax return or touching their lifetime estate tax exemption. For a married couple, that doubles to $38,000 per recipient per year through a process called gift splitting. Gifts within those annual limits require no reporting, no form filing, and no tax consequence. But when gifts exceed $19,000 per recipient in a single year, you must file IRS Form 709, the United States Gift Tax Return. Filing Form 709 does not necessarily mean you owe gift tax. Most people do not because the IRS allows a lifetime exemption that in 2026 stands at $13.99 million per individual. Gifts above the annual exclusion simply reduce that lifetime exemption dollar for dollar. The problem is when retirees skip the Form 709 filing entirely, thinking gifts are always tax-free. Large undocumented gifts can create audit exposure and can complicate your estate significantly. Survey's year track. 2. Medicaid and long-term care. This is where the stakes get much higher, and where families most often discover the cost of not knowing the rules. Medicaid, which covers nursing home costs for those who qualify based on financial need, has a 5-year look-back period. That means if you apply for Medicaid long-term care benefits, the government reviews every financial transfer you made in the 5 years before your application date. Gifts to children, transfers of your home, adding a family member to your deed, all of these transactions are examined. If Medicaid determines that you transferred assets for less than fair market value within that 5-year window, it can impose a penalty period during which it will not cover your nursing home costs, even if you otherwise qualify financially. This is not a hypothetical. This is one of the most common and most devastating surprises families face when a parent needs nursing home care unexpectedly. Retirees who gave their daughter $50,000 for a home down payment or transferred their house to a child to protect it often do so with genuine and loving intentions. The 5-year look-back does not consider intentions, it considers timing. The penalty is not a fine, and the penalty Medicaid imposes is not a fine. The penalty is a waiting period. If you transferred $40,000 or 18 months before applying for Medicaid, and your state calculates a monthly nursing home cost of $5,000. Medicaid divides $40,000 by $5,000 and determines that you are ineligible for 8 months of benefits. During those 8 months, you pay out of pocket for nursing home care that can cost $7,000 to $10,000 per month in many states. The cost of a transfer made years ago without understanding the look-back rule can be devastating, not because of taxes, but because of timing. The Medicaid look-back applies to transfers made to anyone, including a spouse in some circumstances, a child, a trust, or any other party. There are specific exceptions and certain types of transfers that do not trigger the look-back, such as transfers to a disabled child or to a caregiver child who lived in the home and provided care. But those exceptions must be properly documented and structured to hold up under a Medicaid review. If long-term care is a possibility in your future, and the statistics from the Department of Health and Human Services suggest that roughly 70% of people turning 65 today will need some form of long-term care. This is a conversation worth having with an elder law attorney before transfers are made, not after. Where this lands. Here's where this lands. Robert from Florida had all 6 of these patterns working against him at the same time. His savings account interest was pushing his provisional income over the threshold, making part of his Social Security taxable. His IRA withdrawals were compounding that effect. He had never filed Form W-4V, so no taxes were being withheld from his Social Security checks. His RMDs were beginning, and he had no strategy to manage them. He had given his son money toward a used truck without knowing whether it exceeded the annual exclusion. And his income was close enough to the IRMA threshold that a larger withdrawal in a prior year had bumped his Medicare premium. None of these were mistakes that a dishonest person makes. All of them are mistakes that happen when honest, responsible retirees do not have access to the specific information they need. Your action checklist. Here's the action checklist. 1. Calculate your provisional income right now using this formula. Add your adjusted gross income, your tax-exempt interest, and 50% of your annual Social Security benefit. Compare that number to the thresholds of $25,000 and $34,000 for single filers, or $32,000 and $44,000 for joint filers. 2. If you take both Social Security and traditional IRA withdrawals in the same year, ask a tax professional to model the effective cost of each dollar of IRA withdrawal, including its impact on Social Security taxation. 3. Check whether your income is within striking distance of the $106,000 threshold for single filers or $212,000 for joint filers. Remember that IRMA looks at income from 2 years ago. 4. Find out what your required minimum distribution will be this year and in the next 5 years. Calculate whether those growing distributions will push your income into a higher Social Security taxable range or trigger IRMA A. 5. File Form W-4V with the Social Security Administration. If you have not set up tax withholding on your Social Security payments, review your withholding on any pension income using Form W-4P and confirm whether you need to make quarterly estimated tax payments. 6. Review any gifts you have made in the past 5 years, especially large ones. Confirm that you filed Form 709 for any gifts exceeding $19,000 per recipient. And if long-term care could be a future consideration, speak with an elder law attorney about the Medicaid 5-year look-back before making any additional asset transfers. If this helped you identify something you had not considered, share it with someone who needs to hear it. And drop a comment. Which of these 6 patterns applies to your situation right now? 1, 2, 3, 4, 5, or 6? The most common situations help shape future content that protects retirees from problems they didn't see coming.